Wealth management is not just for the wealthy. Everyone is entitled to their best retirement possible. Welcome to The Retirement Engineer with Jim Kruzan, your path to a bigger, bolder retirement. Brought to you by Kaydan Wealth Management, a firm that specializes in serving the mobility technology industry. In this podcast, we help you maximize your resources and engineer your best retirement through a process-driven approach so you can get the little things right. Drawing from years of expertise, Jim and his guests will simplify complex wealth management strategies and explore actionable ideas to help you protect your hard-earned wealth and take control of your future. Now, on to the show.
Did you know how you prioritize your savings can significantly impact your financial future? With tax season around the corner and the new 2025 contribution limits in place, now is the perfect time to rethink your strategy and make sure you're setting yourself up for success. That's where the concept of tax-efficient waterfall funding comes in, a simple but powerful way to organize your savings and investments so you're making the most of every dollar. I'm Patrice Sikora, alongside your host, Jim Kruzan, and today we're going to give you the tools to help reduce your tax burden and build long-term wealth. Jim?
Thanks, Patrice. Yeah, you know what? I wish it was as easy as, hey, let's just save more. And by saving more, we'll accomplish our goals. There might be a better way. And this whole tax-efficient waterfall strategy might just be it. Essentially, all it is a method of allocating extra savings in a certain sequence, ranging from the most efficient and effective way of parking money down to the least effective way of parking money. And if you sort of use this waterfall method, think of it as a waterfall plunging down, you are certain to at least make sure that the savings you do have is working as effectively and as efficiently as possible. And we're excited to present this to you today. It's also important, as it is with any rule, to understand it's not as simple as set it and forget it. This waterfall strategy only works best if it's reviewed at least annually and reset, because over years and year over year, there are adjustments to salary, there are adjustments to funding limits, there might be changes to tax protocol, there might be other funding opportunities that didn't exist just a few years ago that are now available today. And as a result, it requires a readjustment of what the savings looks like and how this waterfall method may be adapted. I'm super excited about this as well, because it's not only for those who are saving. You know, we think of saving this tax efficiently, but this strategy, once you learn it, is incredibly useful and helpful for retirees as well. By just simply reversing this thing, it helps provide a guide path on how we pull money out so that the cash flow that we're creating post-retirement is as tax efficient as possible. Makes absolutely no sense to pull from the most taxable funds if we have the ability to create, say, many years into retirement at a much, much lower bracket. And then some really fun planning can be done as a result of that. And to get into this, I'm pleased to welcome Dylan Stewart back to the podcast. Dylan was a frequent guest last year, and we're calling upon him again to go into the weeds with respect to this waterfall spending or waterfall saving strategy. Dylan is a certified financial planner. He is also a certified public accountant, as well as a wealth manager here at Kaydan Wealth Management. So we're super pleased to have Dylan with us today.
Thank you so much for having me back on, Jim. I really appreciate it.
You betcha. We're glad to have you. And we're so glad to have somebody of Dylan's caliber on the team, because it gives us the ability to focus more closely on the tax ramifications of everything we do. And if the purpose of retirement planning is to make sure that the dollars we have last at least as long as we do, making sure that we're paying as little in tax as possible on the distributions we make helps to elongate that runway and ensure we don't run out of money too early, just simply because we paid way too much tax. So before we get into this, just a little commercial, a quick freebie for those who are listening. If you're really excited and interested in this tax efficient waterfall strategy, we do have a PDF that you can download that is really helpful in giving some advice on what those various steps in the waterfall are. Check our meeting notes for that. So with that in mind, with all the housekeeping items behind us, let's get into this. And specifically, Dylan, let's talk about what this thing is all about. What is a tax efficient waterfall strategy?
Thank you, Jim. Yeah, so it's essentially how can we best put our monies away so that in retirement we can spend them and not the federal and state governments. Something that's extremely important to many of our clients and to everybody out there is you're the one that worked hard for these monies. It wasn't the government that was sitting next to you, typing or doing the engineering. So it's extremely important that you try to kind of latch onto and retain as much of your hard-earned income as possible. So with this waterfall, it is kind of broken out into a few different areas, high priority areas, kind of medium priority areas, as well as some low priority areas on it. And with that, it's extremely important that kind of all the high priority areas kind of go hand in hand, the medium hand in hand. And as you're filling out all those buckets, assuming they are applicable to you, some folks don't have access to certain accounts, but then you can kind of go to the next section. And in the last and final section, there are some nuances to which accounts maybe don't always make sense to put any extra money towards.
Excellent. It's really important to understand this because when we're dealing with priorities, we're often dealing with deferred based accounts, and the compounding effect, the ability to accumulate wealth over a long period of time as a result of this tax efficiency is, it's truly extraordinary. There's an old saying, the best time to plant a tree was 20 years ago. The second best is today. So whether you've been saving all of your life, or you're now starting to get into the idea that you got to play catch up, the best time to consider how you're saving and where you're saving is right now. Compounding is it's the eighth wonder of the world. I think it was Albert Einstein that called it the eighth wonder of the world and said those that understand it. I think he said, to be sure, he said those who understand it will earn it. Those who don't understand it will pay it. And the ability of being able to accumulate consistently on a tax deferred basis is really, really helpful. We not only compound money faster, but using effectively this waterfall strategy, we can create other buckets of wealth that are beyond fully taxable that really help on the back end. When we're kind of reverse engineering this and starting to live a lifestyle off of our accumulated wealth. So now that we've kind of covered some of the fundamentals, let's get in a bit more deeply into what exactly are considered some of these high priority contributions. Dylan?
Yeah, so with that, first thing for a lot of folks, especially kind of your 20, 30, 40, even some 50 somethings, especially before 59 and a half, where a lot of penalties go away in order to access any of your retirement monies, having some money on the side is a high priority item. For a lot of people, it's a psychological need. Dylan, I need 20, I need 30, I need 50,000 somewhere that's readily accessible. Should something bad happen, I'm able to go in and quickly get that. And it actually makes it much easier psychologically for many folks to potentially have their investments sit, especially in tougher down markets, to have it kind of go and go from the trough, back to the peak, knowing that they've got some available cash kind of separately. And with that emergency fund or rainy day fund, the kind of financial planning standard is usually 3 to 6 months of non-discretionary expenses. Not the new shoes, the new car, the new deck, the new vacation, but the utilities, car payment, house payment, groceries, kind of the essentials of life should be kind of saved for in there. And then secondly, another extremely important bucket is making sure that we're getting any of the matching from our employer. A lot of folks think that even if their employer is willing to match and they don't contribute, well, they're just not getting that match. But keep in mind, with any of your employment negotiations, that is as much of part of your pay as the actual check that you receive every single month from your employer. So if they're willing to match, if you put in 3% and they put in 3%, that's an extra, 3% of your overall income that you're able to add to your future self, your future version, age 60, age 65 when you retire, having that money socked away for future you. And again, avoiding leaving any of that money on the table. And then kind of the last of the kind of three high priority buckets is usually high interest debt. A few years ago, when interest rates were extremely low, this was pretty much just credit card debt. Now, there are a few other types of debt that are creeping into here, but for most folks, high interest credit card debt is definitely the big concern that we want to avoid, especially with some credit cards charging 19, 24, 29%. An average, index fund, even ultra aggressive stock fund is usually not going to return that much. So we got to pay down the thing that's kind of stopping us, preventing us from growing our net worth. And with this slide, this PDF that you'll be able to see and download, the kind of percentages that we use as a good guide for what is high interest debt and low interest debt, it's very applicable to a person's age. So on the slide, because I use this for, range all the way from 20 to 80, 90-year-olds, I just kind of have 6% as low interest debt, 7% as high interest debt. But for, say, a 25-year-old with a very high risk tolerance and, just socking money away for their future selves, well, they could probably say anything above 9 or even 10% interest is high interest for them. But say a 75-year-old with a conservative portfolio, maybe it's something much smaller like 5 or 6% interest when kind of making those decisions on where to put your next dollar.
Excellent. A couple of comments about that. We talked about emergency funds. First, it's always best to have an emergency fund that is separate from your regular checking account. It is some other entity. It's also a good idea to start building it by simply having automatic deposits right from a checking account, or maybe right from your checking account to go into that. And when you're looking at emergency funds, these are monies that are just simply going to sit there. They're liquid and available at all times. It's important to make sure you understand the return you're getting on that. There's a huge difference between, let's say, institutional-based money market funds that are very close to the Federal Reserve's discount rate, currently 4+%, and what a money market might pay at a local bank, which in many cases is 0.1%. And if you're considering that this money is sitting there for a long period of time, having a higher yield on that certainly makes sense. And there's a plethora of ways to do that. You get high yield institutional money markets through financial advisors. You can find certain banks that are typically non-brick and mortar. Think of a lot of the online banks that might also have ease of accessibility, but they also, because they don't have the same cost structure as a traditional bank, they can also offer much higher yields as well. We also talked a little bit about 401ks and the importance of funding 401k, certainly to the extent of company match, hugely impactful. It's really hard to describe the impact that a corporate match program has over, let's say, a 30-year period. Just using simple math, if you said, "Hey, I'm somebody who's going to save $10,000 a year. Let's call that 10% of my income. I make $100,000 a year, and let's assume I never make any more than that. Obviously, you would, and those numbers would be even larger still." But at 7% over a 30-year savings, that $10,000 a year grows to something like $944,000, a tidy sum of money. But if you're involved in a plan where your employer also matched, and let's say to the extent of 5%, so now over that same 30-year period, you're no longer putting simply 10% away. That's 10% of your own personal salary, but there's actually 15% being placed within the program. Now, with that same 7% over that same 30-year period, the ending balance is a little bit more than $1.4 million, or exactly 50% more than you would have had before. It's an incredible way to grow wealth. It's an immediate, in this particular case, 50% return on your assets for every dollar you put away. That's really hard to beat. And anything you can do to maximize that really makes good sense. Dylan also talked about reducing debt by tackling the high interest rate loans first. Very important. All the low interest rate loans, you've got a little bit more wiggle room. If you can earn more on your assets than the prevailing interest rate, you can look at paying those off a little bit more slowly. But the high interest debt is burdensome. In fact, it's so burdensome that there have been a lot of studies that have been presented that talk about the anxiety, worry, and stress people have as a result of maintaining and carrying on this kind of permanency of high interest debt. There was a bank rate financial wellness survey that was done not that long ago, and it indicated of the participants, 47% of the participants indicated that they felt periods of anxiety and stress over debt levels they had. And there was also an Ames, I think it was the Ames Public Health Survey, that showed that people who have a relatively high degree of high yielding debt, and to a large degree, that might be big balances you carry forward on credit cards, are 3 times more likely to have some kind of worry-induced anxiety. So not only financially is it in your best interest, but from a well-being health perspective, it's also really important. So those are the high priority items. Let's pivot, and now let's look at some of the medium priority. What are some of the other things we can do if we've already accomplished and are tackling those at the top?
Yeah, and with the 3 kind of medium priority buckets, I like to split them out into kind of 2 tiers. The first tier, the more tax efficient tier, is your HSA. Now, not everybody has access through to one of these from your employer. Some employers provide very low deductible insurance plans, and therefore they are not eligible for this. And in the case that is so, you just kind of go down to the next bucket. But with an HSA, a lot of folks will mention that they're kind of triple tax free. When you're putting money in, tax free, growing tax free, pulling it out after 65, tax free for medical expenses. And another big thing with that is what we see for a lot of folks in retirement is, let's say retirement, it's kind of a 30-year period. A first decade of that 30 years is what we like to call our go-go years, the years in which our health is still reasonably good, our bucket list is very long, our spending usually is reasonably high, all things considered. And then those next 10 years, that second decade, where our spending is much lower, our health is still decent, and then the last 10 years, kind of those no-go years, when our body just starts to fall apart, and the need for money for medical expenses just kind of skyrockets through the roof. So having money socked away for future us inside an HSA can really make it so, as Jim was mentioning, a lot of the anxiety that one may feel wouldn't be present because they've got the money that's able to kind of support their health and well-being as they age throughout retirement. And then also, when it comes to HSAs, most folks don't know this, and most folks don't communicate this to others. But when I say it's kind of triple tax free going into the HSA, that's actually not only federal and state taxes, but you're also not having to pay the FICA, the 7.65%, the Medicare and Social Security kind of payroll taxes, if you're going directly from your paycheck from your employer to their kind of HSA that they've set up for you. So for a lot of folks, depending on how your portfolio is allocated, I mean, 7.65% in savings, I mean, for a lot of people, that's nearly, if not fully, a year's worth of returns that they're just kind of keeping because they're not having to pay taxes on said monies. So for a lot of my clients, I prefer that they think of HSAs, and this isn't everybody. Some folks, they do have to access the HSA every year. It's just a part of the budget, and they don't quite have the financial means in which to save for everything. But for folks that have the means and have the capacity to save in this account, kind of referring to it as more of a medical IRA. Now it's not an IRA, but thinking of it as more of a medical savings account as opposed to, just, hey, I got a small copay here, or I've got a prescription. Instead of paying the $15 out of pocket, kind of just leaving that money in this account to compound for many years to come. And at the age of 65, what's quite interesting about HSAs is that kind of the 20% penalty for non-medical distribution goes away. So even if you're afraid that too many years you didn't pull from your HSA and you contributed to, and you end up getting a very large amount of money into this account, at age 65, any of the penalties for non-medical purposes completely disappear. Now, if you took money out for non-medical purposes, you'd still have kind of federal and state taxes to pay, but those 20% penalties completely gone away. And this is, for a lot of people, maybe a little bit of overkill, but me being the accountant, I got to bring it up. When it comes to an HSA, there's no statute of limitations. So as long as you've had your HSA open, you can kind of determine when you put those expenses in. For example, my wife gave birth 2.5 years ago, and I have a big manila folder with a bunch of receipts, and I transferred those all to an Excel file, so I've got it in kind of two places. But anytime in the future, should I need to get money out for non-medical purposes, I can just thumb through however much money I need, find that many expenses worth, and kind of submit them into the HSA to then pull that money out. Now that's kind of going, if you took an exam, that's going from 99 to that last 100%, kind of getting that last little bit of extra credit. And it does take a considerable amount of time, but it's something I wanted to kind of bring up nonetheless. So that's largely our tier 1 bracket. And then tier 2, from there, your IRA, individual retirement account, and your 401k, 403b, 457, accounts where you can contribute traditional, even non-deductible, also referred to as after-tax contributions. So this year, and every year, as Jim mentioned, it adjusts a little bit, but the 2025 limits for an IRA contribution are $7,000 per year, unless you are older than 50 or older, I should say, and then you get an extra $1,000 for catch-up, versus the HSA that we talked before, that you also have $1,000 of catch-up, but you have to wait until 55. And similarly, with the 401k, you have a catch-up option in there as well, but beyond any matching, you're able to contribute up to $23,500 to those annually on a pre-tax, or depending on your employer's plan, a Roth basis, plus another $7,500 in catch-up contributions that you're eligible for. So these accounts, quite tax efficient. With the HSA, taxes on the way in, with the growth, or on the way out. With these type of accounts, you're either taxed on the front end or on the back end, but not being taxed twice is quite considerable. And to foreshadow, that'll be a type of account that we talk about here in a little bit, in kind of the third lower priority section of the chart.
Well, great, Dylan. Hey, couple points. We talked about HSA and we talked about IRA contributions. So part of it is, especially with HSA, we think of it as healthcare. You alluded to the fact that here at our firm, we think of it as a really slick way to put money away long term. It's a great savings vehicle. So the question then becomes, hey, how do we rebalance this, or should we? Well, the answer obviously is you should. The easiest way of doing it, and the way we prefer, is if you've got an account that you're really not planning on using right away, and that might very well be the case with an HSA, certainly with, let's say, a Roth IRA, the account itself can be invested perhaps a little bit more aggressively, especially considering that there's a high probability that we'll have annual contributions. Annual contributions going into an account allows the account to be positioned a bit more aggressively, because you've got the ability to then dollar cost average. And in the case of an HSA, using the new money coming in as a way of then rebalancing however the original portfolio intent was, is really a very slick and efficient way of doing that. So you don't have to necessarily go in once a year and take some money out of one fund and move it over to another, and take other money out of one and move it into another. If we're rebalancing with new cash flow, it's just a question of buying more of one. We don't have to worry about transferring between, and it becomes an easier way of, frankly, rebalancing the portfolio. There's also been a lot of discussion about IRAs. I think they're terrific, depending on what tax bracket you're in today, depending on what tax bracket you think you'll be in down the road. There's always that debate of, should you be investing for the tax deduction now or tax-free distributions later? But the Roth IRA can also serve other purposes as well. The fact that there is no required minimum distribution allows individuals to fund Roth IRA for an extremely long period of time without ever having to worry about distributing. It's a way of perhaps playing tax arbitrage. If we think taxes are going up, if we're concerned about national debt, we might consider putting more dollars there than otherwise, so that we'll have the ability to pull some of those out. Last thing you'd want to do or realize is in retirement, all of your wealth is in a deferred 401k that's fully taxable, because at that point, there really isn't an awful lot of wiggle room. Another advantage of Roth IRA is if your focus is on heirs, because unlike other vehicles, your heirs will be able to inherit this, again, tax-free. And depending on their circumstance, et cetera, they could have an additional decade beyond the date of your death of additional tax-free growth. And then ultimately, that money will have to come out by the 10th anniversary of date of death. But it comes out tax-free, and it provides a lot of opportunity for planning, education funding, whatever the case might be. It's also a way of kind of double dipping or using the Roth IRA in a couple of different instances. We know that there are penalties involved if we pull it out early. Those penalties surround whether we can pull the earnings out tax-free. However, in every case, you have the ability to pull out your cumulative contributions at any time for any reason with absolutely no cost. So imagine somebody who's religiously contributing to a Roth IRA for 10 years. They might have as much as $70,000 in there as contribution. If they needed some of that because they underfunded college education, they'd at least have access to that without penalty, without tax. As long as you left the earnings and such in the account to continue to grow, you're fine. Some people even consider it, although I don't prefer it to be the case, but they consider it an opportunity for an emergency fund. Well, I've got this Roth. I've got a lot of money in there that I've saved over time. I know if an emergency came up, I could access this right now without penalty. So it's a way of kind of double dipping if we needed to, which is kind of interesting. The key, though, with all of this, Roth, HSA, 401k, is we need to kind of consider diversification, and not in the sense of do we own stocks and bonds or US or international, but where do these individual accounts sit from a tax perspective? Because although we're saving today, we're seeing the effect of our savings today on our taxes, we also have to take into consideration what that's going to look like 15, 20, 25 years down the road when we retire. Do we think taxes are going to be higher or not? And one of the keys is to make sure that we have multiple buckets with different tax effects that we can then pull from, so we have the ability to create cash flow. We don't want to pull it all out of an IRA. We don't want to pull it all out of a taxable account with capital gain. If we can mix some Roth distribution, we can mix some tax-free distribution out of a taxable account, and then some taxable distribution out of an IRA, we can actually manage and set your effective tax rate. Now it becomes a proactive planning tool, as opposed to here are all my receipts, tell me what tax I owe. And it's incredibly impactful. So consider some of those things as you're tearing down and filling some of these buckets. Incredible opportunities, incredible value as we start to grow wealth amongst some of these diverse tax buckets. Let's now move along down this waterfall. And Dylan, why don't we talk a little bit about the low priority contributions?
Yeah. And with the low priority contributions, there's kind of a few buckets. And again, all of these are very dependent on one situation. Kind of the first bucket I like to refer to is kind of your education or disability expenses. Think 529 education accounts or MI able accounts. And some states have various versions of that, but basically you're able to get a bit of Michigan state tax savings, and for other states with state income taxes, also for many of them, state tax savings as well. But having that money, instead of sitting in a brokerage account for your child, that's with the intention that these will be used down the road for education purposes, by putting them into a 529 account, you're able to invest those monies as well. And with any of your contributions, you're able to, contributions up to $10,000 for a couple, 5,000 for an individual, you're able to save kind of that and write it off your Michigan state tax return. So it's quite a few $100 worth of savings that is allowable and provided to you. And then from there, and with those 529 plans, it's one of those, as a parent with a 2.5-year-old and a child on the way, it's in many ways counterintuitive to think of that as a lesser priority, my child's education as a lesser priority than my own retirement. And it's one of those when you're kind of on a plane and the loudspeaker comes on and they say, you know, in the event of turbulence, make sure to put your mask on before you put someone else's on. It's kind of the same thing with the financial planning. The government is offering you a lot more tax advantages by saving for your retirement, and they're only offering kind of a little bit for you to save for the next generation. You can borrow for their education, you cannot borrow for your retirement. So at the end of the day, think about it more as the overall family's net worth and what am I doing to boost that as quickly as possible, and not so much that, well, I'm only giving to myself and not so much to my children, as you will have other means in which to potentially be able to help them down the road, even with those more kind of medium and high priority, more tax favorable options that you've saved through over the years. And then from there are taxable brokerage accounts, individual accounts, trust accounts, very useful for flexibility, but they come with a much higher tax burden, much more kind of nickel and diming from the federal and state governments. When you put money into an IRA or a Roth IRA, if you buy and sell, there's usually no tax implications, or there is not tax implications until kind of the money was either put in the account or pulled from the account, but all the kind of miscellaneous changes along the way, again, no tax implications. But for a brokerage account, when you buy, let's say, $100 worth of Apple and they pay a dividend, well, depending on your tax rate, you're going to owe some long-term capital, some taxes on said dividends. And then let's say you hold that Apple share for a year and a day, and that $100 share becomes $200. Well, as long as you don't sell it, that $100 of unrealized gain is not taxable, but as soon as you sell it, depending on your tax situation, you can be taxed anywhere from a federal level of 0 to 15 to even 20%, and then, you know, state here in Michigan 4.25%. So any bond you hold, you know, interest that's paid, again, part of your reportable income each year. So very much nickel and dimed along the way. But what's very nice, kind of backing off what Jim said regarding the emergency fund, kind of can also be used as a Roth IRA with any of your contributions, can also be considered as part of your brokerage account too. For a lot of folks, first starting off, the emergency fund, high priority that you get that done. But eventually it comes to a point where if you've got a bunch of accessible money, should something bad happen in your family or in your financial life, you can access the Roth IRA and take out some contributions. You can access the brokerage account, get some money out, determine what has gains, what has losses, sell those things to net out and not have any gains that you have to recognize on your tax return, and get those monies, as Jim said, tax free. So eventually, for many folks, the emergency fund, there may be a psychological need for it. I still want $20,000 inside of an account somewhere that's liquid, but you don't need it anymore. You can have that money working a bit harder for you than just, you know, earning a few percent of interest per year on average. We know that bonds, especially stocks, over the long term, earn more on average. So with that taxable brokerage account, what's interesting about it is all these other accounts, they have funding limits and in terms of how much you can put into it, versus a brokerage account, you can put an infinite amount of money in, which is why on the slide, on the PDF that we'll be providing, that's kind of the last bucket you see next to all of the other accounts that are available, because this next bucket is one that for most people doesn't make sense to put extra money towards, and that's low interest debt. On the slide, 6% or less. In many ways, taking your money and putting it somewhere else to a more tax efficient account, an HSA, a Roth IRA, a 401k, even a brokerage account, is going to provide you much more kind of financial flexibility and liquidity as the years go on, albeit I know a lot of folks, Dylan, it is so nice having the home paid off or having the car paid off. It feels like I don't have that kind of debt noose around my neck and I feel much more free. But at the end of the day, we care less about how much assets you have and how many liabilities, how much debt you have. At the end of the day, it's that assets minus debts number, that net worth number is ultimately going to drive your retirement down the road. So if there is opportunities for you to invest at a higher rate and possibly even get tax benefits at that higher rate of average return over and above what you'd be paying down low interest debt at, well, in that case, even though in the moment, we don't know where the market's going tomorrow, but over many years of making this same decision, it's going to down the road lead to much more profitableness and higher net worth for someone that does that. And kind of one more account, and there's a few types of other accounts out there, many of which not so common. This one for a lot of folks, not quite so common as well, but I do want to bring it up, is what's called an employee stock purchase plan. Some employers, usually very large mega corporations, allow for their employees to take part of their paycheck and put it towards these employee stock purchase plans, these ESPPs. And by doing so, a lot of them will actually give you some type of discount, whether it be 5, 10, maybe even 15% off the price of those shares, as long as you agree to hold them for a specific amount of time. So that one's not something that I've integrated directly into the actual Waterfall, but something that I kind of have off to the side just because we don't know what your specific situation is and if that makes sense to kind of take advantage of, because I've also heard of many folks that have employee stock purchase plans, but their employer is not offering any discount for you putting money into, at which point it becomes not such a high priority.
Excellent. A lot of information there. Hey, we talked a little bit about college education funding. I just want to touch on a couple of points. Actually, really a reiteration of some of what you've said. I've been doing this a long time, and I've seen in many cases folks who are at retirement age or very close to retirement age, and they were maybe planning on retiring a few years later, but their employer had different thoughts. Maybe there was a health issue that compromised them, and they're dragging ahead sooner the retirement date. And in those cases, generally where they are really totally ill prepared, it's because they were just really terrific parents and they sacrificed and made sure that they paid for their children's full education. They made sure that the kids would graduate from college without any degree of student debt. And by doing that wonderful, great opportunity, it denied them. The idea was, I'm 52 years old. I just wrote my last tuition check for my youngest child. Now it's go time. And I've got the next 10 years to put it all away. That's the most inefficient, ineffective way of thinking when it comes to retirement planning. There's a famous saying that I coined that says you can borrow your way through an education. Try borrowing your way through a retirement. You just can't. There's no other choice. So that's why this whole waterfall strategy is really effective, but it's even more effective if it's being worked at in conjunction with working closely with an advisor. Because there's so many other iterations, so many other things that need to be considered that have a meaningful impact on the end result. Your bigger, bolder retirement is a function of so many of these things being melded together. One other comment on taxable accounts. I don't like using the term taxable. I prefer to use the term tax preferred, because the way I look at it is the savings in that account. I'm thinking of a traditional brokerage account where you're owning a combination of fixed income and equity funds, individual stocks, ETFs, whatever. There's a lot more flexibility around the taxation of that account than in other types of accounts we might invest in. As an example, yes, there might be some dividend and yes, there might be some interest, but some of that dividend might be qualifying dividends and they might be taxed at a long-term capital gains rate. And that capital gains rate might actually be lower than the marginal rate you're in otherwise. There's also ways to tax manage the account throughout the year where we're kind of staying ahead of losses and taking some of those. If I've got a security that I have a loss in, I want to take it. And if I really like that security, I can buy it back in 31 days. Not a big deal. I can buy it back next month and still maintain the position. But now I've got the loss, and I can use those losses to offset gains. So in many cases, we've structured cash flow with clients that after they fully retire, the cash flow they're using to live their lifestyle is coming from several different sources, but generally the sources coming from the taxable account have very little, if any, tax consequence because of this offset. Also, if you think about it, in retirement, when you're now 73 or older and required to do your required minimum distributions, in many cases at that time, the required minimum distribution that you need may be vastly more than you actually need as a result of cash flow. So what normally happens is we take the required minimum distribution, we withhold the commensurate amount of tax, and then that amount that's left goes back into and gets reinvested back into this taxable account, allowing it to continue to grow. And if you think about it, it doesn't really quite happen this way. But as the IRA diminishes because of yearly required minimum distributions, that joint account continues to rise over time because of all the additional savings. And your heirs will love it because currently there's a stepped up cost basis. So when you give the gift of an IRA, tax bill attached, when you give a gift of a taxable account, tax free. So at least in my vocabulary, in my dictionary, it's a tax preferred account. We all know it as a taxable account. So I just wanted to mention that. Well, listen, we've talked about, to a large degree, saving for retirement, the accumulation phase. Let's switch really quick. And Dylan, why don't we talk a little bit about briefly just kind of what this looks like in reverse? We get to the point where we're flipping the switch. We're now taking money out of these accounts. How does this waterfall then work and serve our decision-making process?
Yeah. Yeah. And with this waterfall, kind of flipping it in reverse, starting from the bottom and spending those monies up, kind of your brokerage account monies first, it creates a lot of opportunity to make some adjustments to your accounts throughout the years. What I mean by that is when taking distributions from, as Jim mentioned, a tax preferred, a taxable brokerage account, especially starting off, let's say you're retiring at 60, we don't have Social Security starting until 67 or 70, required minimum distributions at 73 or even 75. Well, with those taxable distributions, one can kind of match gains with losses and get you much of that money without any tax implication whatsoever. So by doing that, by taking the monies from those brokerage accounts, especially in the years before Social Security turns on, required minimum distributions turned on, it creates more capacity for Roth conversions, potentially taking some of your pre-tax dollars in a 401k or IRA, moving those over to an after-tax, a Roth IRA, paying the taxes at a much lower rate than you kind of project to be down the road once all your levers are turned on, Social Security and required minimum distributions. So by starting with that brokerage account, kind of spending and depleting it, and not wholly, there are instances where it makes sense to take some money from the other accounts, depending on what the marginal tax rate is for you then that year, and under the current administration and what they have in place. But again, starting with something that's so tax preferred and then kind of working backwards can provide a lot of opportunity. And as Jim mentioned before, kind of having that tax diversification as we're planning our spending strategy throughout the year and then kind of tightening everything up before the end of the year, having a few different buckets in which we can pull money from is extremely important, because what we see for a lot of retirees is with a lot of our planning models, you kind of increase it every single year, how much they're spending by, call it 3.5% inflation. It's a very linear model in terms of how much it goes up by. But in reality, what we see for a lot of clients is it might be a very high spending year, then a low spending, then a medium, then another high, then a low, and then a low. And it doesn't all come the same exact amount every single year. So by having a few different tax natured buckets, we can go in and take advantage of the tax tables of the day to be able to get this money to you as tax efficiently and tax cheaply as possible to, again, as I said at the beginning of this conversation, to make sure you're spending your retirement dollars and not the federal and state governments.
Excellent. Big key there is it needs to be a dialogue. It's got to be a consultative process. Every year, the dollar amounts change. We have clients who we will take money out of an IRA, which is a taxable event, but we'll only take that up to, let's say, the 12% capital gains or the 12% marginal income tax rate, because at that point, we know capital gains are free. So what we'll do then is we will switch somewhere throughout the year and pull money out of one of the other buckets. And when we do that, when that switch off can vary month to month, quarter to quarter, each year, depending on what else is going on. We're now taking Social Security. We weren't taking it before. That changes the whole dialogue. We're now involved in required minimum distributions. We weren't before. So it's important to have that dialogue. And every year we should be mapping out or essentially tweaking what that cash flow will look like. What you don't want to do is get to the end of the year without having some sort of that dialogue, because at that point it's simply just too late. And more than likely you've been taxed on more than you needed to be. So an important point there. In closing, let's just summarize here a little bit. So if I were to summarize what we've heard today, I would say really important, we've got to kind of prioritize our contributions. We've got to look at what we can budget and where best to put that money. We want to be able to lever and use leverage with all of our tax advantages. If we've got something that will give us an advantage, a tax advantage, or hey, we do this and we get a match from an employer that we wouldn't have had before, we want to take use of that. And the other thing is the areas that we invest in, where we assign that priority, we have to be cognizant of the fact that that might change over time, depending on where we are in our life cycle, how close we are to retirement, or other things that are going on. Once again, as a reference, we've got some really good deliverables. Check out the tax efficient waterfall strategy PDF in the meeting notes. And we encourage listeners to review their own funding priorities. When people say how much I should save, I say as much as you possibly can. I will also tell you that the old rules of thumb have changed. Back in the day when I first started practicing, the idea was a 10% solution. Let's save 10% of our salary and everything will be fine. Well, roll ahead 40 years. Many people today are not covered under pensions. They were back then. There are a lot of other issues and concerns regarding Social Security, et cetera. So the more you save, the better. I've never met a client in retirement that told me he was upset because he saved too much or he had more money than he thought he should have. That's never been the case. I prefer to use something that's a bit closer to a 20% rule. And if you can't do it immediately, we can work into it. That's important to consider as well. Dylan, what comments can you lend us today as well?
Yeah. So when it comes to saving, definitely 20%. For a lot of folks, they'll kind of include the employer's contributions plus any of your contributions to get to that 20. A lot of the data does say, 10% might be a little bit light. 15, now we're talking, and as Jim said, 20 will be quite confident. If we're starting in our 20s, working for a number of decades, saving that much, you'll be in great shape. And from there, aligning our tax efficient strategies, especially with your individual goals, is a must. It is so important since for most people, pretty much all people, your biggest lifetime expense is taxes. So we want to legally minimize what the federal state governments receive from all your hard work and efforts.
Terrific. Last thought, Dylan. Hey, thanks so much. Thanks for joining us again. Thanks for helping us kick off the tax season. And thanks for imparting some really good information about this tax efficient waterfall strategy. Thanks so much.
Thank you so much for having me, Jim.
You betcha.
This discussion underscored how prioritizing your savings can help maximize tax advantages and build long-term wealth. From high priority contributions like emergency funds and 401k matches to tips for retirees using the reverse waterfall strategy. We've shared actionable steps for every stage of life. Don't forget to download the tax-efficient waterfall funding strategy for a detailed guide and reach out to your wealth advisor to ensure your financial strategy aligns with your personal goals. If you found this episode helpful, please subscribe so you don't miss future episodes and share it with someone who could benefit. Follow @Kaydan Wealth on social media. Let us know what you think in the comments. Your feedback and topic suggestions Help us improve and make a bigger impact. And thanks for supporting our show.
Thank you for listening to The Retirement Engineer with Jim Kruzan. Click the follow button to be notified when new episodes become available. Visit our website at www.kaydanwealth.com or give us a call at 800-638-6900. The information covered and posted represents the views and opinions of Jim Kruzan and this episode's guests, not necessarily those of Kaydan Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.